to the Futures Edge Unfiltered Flash. I'm Jim Iuorio. That's Bob Iachino. Okay, here we go. Now we should have a drum roll, because one of the reasons we have Steph on here is because she unleashed a policy suggestion to whoever's going to be the new president at the end of this ridiculously hard-fought election, and something that we think is brilliant. And I'm going to have Steph explain it to you before I'm going to tell you what I love about it. But ladies and gentlemen, Steph, pitch it to the president.
Okay, well, I just looked into this idea because I have a friend here. You know, this is how these ideas come. But I have a friend who's getting divorced, and she was worried about what she's going to do with her finances. And she was asking me, what do? I need to open an account, and what should I buy, and whatever. And, I was telling her, well, you might just for now, to avoid taking any big risks ahead of the election, because God knows what that's going to do to the markets, just park your money in cash. I mean, you could get a nice yield on T-bills. And she asked me, well, do I have to pay tax on that? And all of a sudden the wheels were turning. And I'm like, that's interesting. Why do we have tax on Treasury securities? Wouldn't you want to encourage domestic investors to buy treasuries the same way you encourage them to buy municipal securities? And especially at a time now where we're running these monster deficits and our one-time foreign creditors have long since left the building. We just got the latest Treasury capital flow data last night. And foreign central banks are buying $30 billion annually of U.S. treasuries. 30 billion. Our deficit is 2 trillion. So, I mean, we cannot finance our deficits by relying on the kindness system. It is mind-blowing. So at some point, the rubber's going to hit the road where we're issuing $2 trillion or more, God forbid, if we go into a recession and the deficit goes to 3 trillion, at a time when we can't rely on our one-time, vendor financiers around the world. And this idea of eliminating the tax on treasuries would create a whole new audience for Treasury securities.
Just for domestic buyers, correct? The tax?
Exactly. And ultimately, I view that as a much more sound and stable source of financing. I mean, right now, of the numbers I just referenced, where foreign central banks are buying 30 billion annually, foreign creditors in general, including like Japanese insurance companies and all that, are buying 500 billion annually. So it's a lot more than just the central banks, but it's still nowhere close to what we need to fill this funding gap. So we need to come up with a solution to this. And I like the idea of having a stable domestic audience, in addition to those Japanese insurers and other foreign institutions that are buying 500 billion. Right now, what appears to be supporting the Treasury market is, and you guys probably know more about this than I do, but this Treasury basis trade, where leveraged speculators and hedge funds are basically gaming this minute spread between the cash and the futures market with massive amounts of leverage. I mean, I've seen reports of, 20 times leverage. This sounds eerily familiar to me to what LTCM was doing back in the day. So,
you had it all figured out, though.
Glad we can laugh about that now.
I mean, it's terrifying if that's what we're relying on to fill this gap between the supply and the natural demand. But the reason why I really like this idea is that, to me, I've wrestled with this for a long time as to what we're going to do, because this exodus of foreign creditors isn't new. It's been going on for years and years. And not surprisingly, really started after we implemented the unconventional monetary policies with quantitative easing after the global financial crisis. And then the dollar share of global Forex reserves, just kept going lower and lower and lower. So I've been wrestling with how are we going to solve this problem for a long time. And that was before the deficits got to 2 trillion. And, I've thought of things like maybe the government will mandate the public pensions hold some huge portion of their assets in safe Treasury securities to create some sort of demand. But what I like about this idea is that it creates this new source of demand and prevents what I saw was the inevitable re-expansion of the Fed's balance sheet as it picks up the slack left behind by the foreign creditors. And we end up having QE infinity, which a lot of people have talked about for years, with all the dollar debasing purchasing power destroying consequences that continue to eviscerate the middle class in this country.
Well, Steph, we got a little bit of pushback on this, and I know what my answer to this is, but somebody immediately came on and said, wouldn't that crush municipals, which state and local governments rely on their tax-free status as one of the selling points of those? What's your view on that part of it?
Well, several things. Number one,
I know one of them is.
yeah. Number one, why should state and local governments be given priority ahead of the federal government? That I don't, get that rationale. I guess we can engage in a debate with someone who's a big proponent of that, but it doesn't seem to me like there's much reason for that, particularly at a time now where we're running these massive deficits to the point that it is, in my view, a national security issue, because we're talking about the dollar and its future as a reserve currency. And these deficits, which clearly neither party really has any interest in tackling aggressively, aren't going away. So next month, the timing of this conversation is great because next month, the BRICS Plus members have their big summit in Russia. That's, I think, October 22nd through the 24th. And they've been working very frantically to create an alternative trading currency to the US dollar for the member countries. So it's not like all of a sudden the dollar reserve status is going to go away, but this is a major challenge to the dollar's role at a minimum in terms of global trade financing. The financial flows and the SWIFT and all that kind of stuff is another issue, but these countries will all trade together in presumably their own unit or brick or whatever they decide to call it. So I think this is a national security issue, and I would therefore prioritize, the federal government over the state and local governments. So that's one thing. The second thing is, and there's no way to know until it happens, but I would presume that it's not going to hurt state and local governments. I mean, if I own a municipal security and let's say I'm getting 5% tax free, I could turn around and say, all right, I can buy a treasury, but presumably that treasury yield is going to be 2, let's say. Yeah. So you're still being compensated for taking a little more risk in the state and local area. It's not like their rates are going to go up. Their spread relative to the treasuries will go up, but their nominal borrowing costs shouldn't change at all. I can't see any reason why their nominal borrowing costs would change, barring their own fundamental outlook changing.
Well, that brings me to my last question here, because that was going to be my point. Number one, maybe this will be a kick in the ass for state and local governments to get their affairs in order. Yeah. But also, you're not suggesting this as a budget deficit corrective measure, although it might have that effect. Is that right?
Yeah. I mean, if you do the math, it really does, which kind of begs the question why no one thought of this before. If you just think we're paying out $1 trillion roughly in interest each year, the average effective tax rate across the entire United States is 15% on individual taxes. So figure we're losing out on $150 billion annually in terms of tax receipts from the interest. That vastly overstates it, though, because $8 trillion of our treasuries are held by foreign investors. They're not paying tax on the interest they're getting. So but nevertheless, let's call it $150 billion that we would be foregoing in terms of the income from the taxes on that interest. Every 1 percentage point decline in Treasury borrowing costs on $35 trillion in debt reduces the debt service by $350 billion. So the math is so compelling here. You lose 150 to gain 350, and obviously the more the Treasury rates go down, the better the math gets, because you're losing out on less interest income and you're further reducing the debt service, which, as you know, is now the fastest rising portion of the deficit.
I totally love this. I love everything about it, except for the fact that it makes it easier for the government to get money and continue their drunken sailor spending. But that could be the key carrot that allows them to say, what did they say on that show? Okay, because they might certainly, because this is really an excellent idea. By the way, we're running out of time. I don't want it to be, it's the unfiltered flash. It's supposed to be a short, but when we have Steph Pomboy, and we tend to talk longer because we want to pick her brain. Thank you guys for joining us. This is Futures Edge Unfiltered Flash. I'm Jim Iuorio. That's Bob Iachino. That's Steph Pomboy. Thank you guys so much for all the DMs, the retweets, the follows, the subscribes. You guys are the best, and none of this works without you. We're trying to form an independent journalism platform, and this is the way it's got to be done. It's no sponsors. I mean, no sponsors who pressure us to say bullshit stuff, but thank you guys for being part of it.